Hey everyone, welcome to Finquinity's podcast, episode 6.
Welcome back. How's it been?
It's been a flat week so far, apparently, but with more volatility right now overnight, more than I expected. Just looking at the markets, it seems to look like the NASDAQ flatlined, slightly declined a bit compared to Monday, but overall markets remain bullish. And we had major companies like NVIDIA hitting all-time highs.
Oh,
and
absolutely.
Bitcoin also hitting all-time highs.
I think what surprised me was how much Bitcoin moved in that one singular day. It went from 111 to looks like 117 or 116,000.
Yeah, that green god candle was definitely a big one. People, pretty sure, were very surprised with such a huge rip. And I've seen articles where billions of dollars worth of shorts were basically liquidated.
I've seen that too.
Very unfortunate. And I think that may have contributed to the rip as well, because a lot of them probably had to cover, and that created even more buying pressure on that end.
Right. That's been that. I think, has there been any other significant event in the market? I think.
Well, the market has basically flatlined a bit. It kind of declined. So I think that indicates some sort of consolidation, which I honestly expect at this point. The NASDAQ and the rest of the indices have been ripping for quite a bit now. I really do expect that there is some sort of pullback, but I noticed that every pullback, it seems to be quickly bought out on the day of. People are fighting for those sales, and once the day opens with a red, it usually you see a V-shaped recovery, which is quite impressive. Every single time I've seen any pullback, that's been happening. And I think that is really indicative, along with Bitcoin's rip, that we are in a very low volatility, risk-on environment.
I think, to be fair, I think the trading volume is also seemed to be reducing. I mean, at least for last week compared to the weeks before. So it looks like it has just been a consolidation week.
It has. But what I've seen so far, at least, is that seems to be changing.
Oh yes.
Because over Saturday, and I think over the last couple of days, Trump has announced delays on those tariffs, but he has actually raised the tariffs to around 30% on EU, Mexico, which will happen on August the 1st, according to what he says.
Yeah.
And also he wants to implement tariffs on Canada.
Yes.
So
that was a surprise that came last week. Was it earlier last week? Could you clarify?
I think it was earlier last week. I don't remember what day it was, but this guy just basically makes random announcements, so I can't keep track, right? There's always a different announcement.
Yeah.
But I know specifically that one happened on Saturday, and right now we're seeing the results of it because it did spook the markets.
Let's have a look at the futures then. The futures are clearly 0.5% below. The NASDAQ futures are 0.5% below. S&P futures are also 0.4% below. So it is look like Monday is going to be an interesting day. I think usually if you see the futures down 0.5% this early, it's not. It can be indicative of a bear day on Monday, but at the same time, I've also seen it down 0.5%, and then Monday morning, it's just purely bullish. So it can go either way. Right. But I think we both hope for a pullback, right? I think at the moment we're looking for entries ourselves. It's been quite a while since we had a nice entry into the market. Looks like the last real entry was 23rd June, 24th June, so around 2.5 weeks ago, 3 weeks ago.
That's right.
I think overall we're happy with a pullback, right?
Yeah, exactly. This definitely gives people some opportunity to enter in. I've been recommending to some clients to buy every noticeable dip that you can see, because just based on the VIX, just based on the Bitcoin price, based on the low volatility environment with all these companies ripping up, and the patterns that we have seen so far, these dips are worth buying.
Mm.
Once you see those dips, it's very difficult for you to see them happen again at those levels. So overall, this is good for the market. This is healthy. This
Yeah,
consolidation,
yeah, yeah, yeah.
and this overall pullback is quite healthy as well. I'm very ecstatic to see this sort of behavior. Now, in regards to those tariffs, just winding back a little bit, and we've been kind of talking about this for a while.
Yeah.
It seems to me that the taco Trump trade, or Trump always chickens out. That's what it stands for. That trade seems to be working quite consistently. Basically, he makes an announcement, and the stock market goes down a little bit. A little bit of fear comes in. You buy it, and then it rips afterwards because markets really quickly get over that fact. And that seems to have been the meta over the last couple months, and it continues. And hopefully it will continue here. And maybe you can kind of pull up the model on your screen. But essentially, if we look at the NQ1 futures right now, or NASDAQ future, the candlestick seems to touch right at the kernel regression
mean. Yeah.
Right. So things are looking pretty solid so far.
And I expect a healthy bounce, a bounce upward all the way back to the zone 1 boundary to get into a strong bullish sentiment. But to be fair, next week there is critical data.
There is.
For the viewers, we must apologize. In last week's podcast, we claimed that the CPI data was on July 8th or July 9th, the last week. Well, we got it wrong. That's our bad. The CPI data is actually going to be July 15th, Tuesday, July 15th, 8:30 a.m. And in the data, you will see the core inflation month to month, core inflation rate year to year, inflation rate month to month, inflation rate year to year, and then the day after, you'll be seeing PPI month to month. Let's talk about this data, because I think the market has been largely uneventful in the previous week, except for like the Bitcoin, but we can circle back to that later.
Yeah, sure. So last week's most significant information has been the Fed minutes that were released on Wednesday. So just to recap what the Fed minutes are, they're essentially transcripts and details that were based on last FOMC's meeting. They're generally released later to give the market time to kind of process the FOMC decisions and then to skim over the details afterwards, so that's not a surprise. And a lot of the board members on the committee were quite cautious and careful with their decisions for rate cuts. So far, most of them believe that inflation risk still remains a fact, based on tariff fears and potential crises in other countries, specifically the energy prices due to Middle East conflict. They do believe that current interest rates are now very close to what is considered a neutral rate. So the neutral rate is essentially the interest rate that they believe will not be too restrictive on economic growth, but also will not be expansionary. Expansionary means a policy that can potentially overheat the economy and cause inflation. Now, in this case, because they're quite cautious, they somewhat support a cut in July, but they want to see what the data presents itself. If unemployment is bad, and unemployment is shooting up, and job creation is getting low, then they might consider cutting. But if the data was good, and we did see good job data like 2 weeks ago, then they might delay the cuts and might do it in September instead. So, all things considered, they're still quite cautious. They're not promising any cuts yet. They haven't communicated any of that. But the most important thing so far, besides the interest rates decisions, is that they are planning to end the Fed balance sheet drawdown by February 2026 instead of January 2026. And what that balance sheet is basically the Fed essentially printing money and buying up bonds and mortgage-backed securities on the stock market, which can stimulate the economy and potentially stimulate equity markets. They have been drawing that balance sheet down because of inflation risk. They have been drawing it down since 2022 now. And they're planning to end that, which, in my opinion, is essentially saying that they feel that they've done enough work and they're going to take some pressure off the economy's neck so that equity markets can continue pushing up higher, especially once this balance sheet drawdown pauses.
That's good news.
Yeah, exactly. So that has been, pretty interesting. But overall, that was a summary of the minutes. Nothing too crazy. If it was crazy, you would have seen the markets react very well, right? Or very poorly. But we haven't seen that. Very flat.
No, I think if we just have a look at the day in particular, I think it's like Wednesday, right? If you look at the hour by hour graph as well, I feel like there wasn't too much of an impact on that day. There was not much of an impact. I think it did see a rise on like the NASDAQ of like 0.2%, but that's relatively insignificant in the grand scheme of things. So
exactly,
no impact per se.
That's right. That's right. Now, I also want to discuss a little bit about our forecasts of what can happen next week.
Yes.
With the data, presenting itself as CPI and PPI, I do think the markets might move quite a bit. We had some consolidation, so it could be a good trigger for more bullish sentiment, especially if CPI continues to improve over the coming months, right? So I do think, and that's just me saying this, I think that the inflation risk from the tariffs will be quite insignificant, and that markets will continue pushing up. That's my forecast for this week.
So I would agree with you. At the same time, I would say that I think people are expecting this month's CPI and inflation to be higher. I think like if you look at the trend from just 2025, I think the inflation is just rising throughout the year. And I think people are predicting there to be about 2.6% inflation. I forget what the CPI number is. I don't have it off the top of my head at the moment. But people are predicting higher, or forecasting, I should say, a higher CPI and a higher inflation rate for the report. And so, based on how the market is reacting, if the expectation is met, I expect nothing more than another slowish week where you would see the market happen. The market would slowly tick upward, especially in NASDAQ and S&P 500, and everything else would kind of remain the same. I think the only cases where it would be a positive or a negative is like a 30-20% chance, respectively, of a larger than average change or away from the prediction. So I think where I'm leading with this is I'm actually expecting the prediction to be either on forecast or slightly above forecast.
Yeah.
Are you with me with this, or are you saying or are you saying it's going to be lower than the forecast?
No. So what I'm saying is that the inflation, like I'm looking at the forecast right now. The forecast is 2.7 compared to the previous results of 2.4. So no doubt that the results are expected to be higher, but the market has definitely priced that in. Right? They're not going to be surprised and be like, oh, what is 2.7?
No.
And even though that's public knowledge, right?
Yeah.
If it's above 2.7, then they'll be freaked out.
Yeah.
But if it's 2.7 or less, I would expect the market to be quite bullish because they've already priced this data in, and just judging by the bond market and how it's behaving with TLT, TLT seems to have also slightly priced that in. Like it's been just chopping right now, right? So,
yeah, it's been on a tear. It's been on a tear downward, I should say.
Yeah, exactly, right? So if we seen a big inflation surprise, we would have seen TLT get sent down back to the abyss, but we haven't yet. It's just chopping, and I think that indicates that the market does kind of expect a higher level reading this like for June, but it's not so high to the point where people are afraid that hyperinflation is back on the table.
I mean, like at worst, you would probably see like 2.8 instead of 2.7, or like the 2.
Yeah,
like just like a 0.1% higher.
Exactly.
And I don't think in that scenario you would see a mass sell-off. Maybe like I think you would see a bearish week. Overall, but I don't think it would be a flip in the risk-on regime. It might stall the regime, but I don't think it would be a momentum killer.
I would say it's just probably another dip to buy at that point. If people are a little bit spooked, these dips again are worth buying. The risk sentiment is quite strong, and we're seeing everything getting bid up. Like even the crappiest of companies are being bid up, and if Bitcoin continues being at this level, and Bitcoin is foreshadowing where the market's moving, I'm quite confident that markets will continue, just slowly grinding higher over the next couple of weeks, just in the long run.
What's surprising me today is that usually Bitcoin is a great indicator of risk on asset and risk on sentiment. That the Bitcoin is separate, is moving separately from the NASDAQ futures. While the NASDAQ futures are down 0.4, you can see Bitcoin clearly up a few amount. Let me just have a look. It looks like 0.6 today, or 0.55. So I'm a bit surprised, but I think that mostly comes from the breakthrough that we saw through the Bitcoin resistance. I think Bitcoin has been resisting the 112,000 mark for looks like quite a while. Let me just have a look at the resistance. Around 50 days, 49 days. So since May, it's been resisting. So we just saw a breakthrough, and I think people are quite happy with the breakthrough. So maybe it's the leftover momentum from the breakthrough, pressing everything upwards up until the next point of resistance.
Yeah, exactly. Like on that note, I do think that people are now are getting acquainted with this new price action, this new price level, and it's becoming consolidated. To the point that people are no longer surprised seeing Bitcoin above 110 or even 105 at this point, which is good. Which is good for risk assets, right? If Bitcoin continues goes up, that's very leading for tech stocks like the NASDAQ and stuff. But overall, I'm not super bearish. I'm not too concerned about this coming week's data. If data does change, though, of course, our predictions will also change along the way. That's just how it goes here. And the other thing I want to kind of talk about is our model has gotten a big makeover since last week, right? Want to talk about that?
Yeah, absolutely. Since last week's update, there's been a fundamental change where the features of the model were already present. We made them more visually apparent for the clients, for the users. And I'm going to talk a little bit about what these features are. To start off with, there is going to be a confidence bar. So the pane at the bottom where you see the blue and the orange columns, this is what we call our prediction score, and it ranges from -8 to +8. The more positive or the bigger the number, the more confident we are about the direction. And what these numbers mean is that this number tells you what the model is predicting the stock to do 4 bars from now. So if I take a look at Bitcoin today, it's predicting +8. So what that means is by the close on Thursday, it's predicting the price to be higher than the price it is today. That is going to be model 1. And you can have if you have a look at the bars below, it is on track with the regime, where if you look at the reversal with the first orange bar after the long streak of blue bars, you can see it largely correctly predicts the change in the regime from a purely bullish regime to a more choppy sideways regime. And it's a good indicator for both the future and also historical behavior as you want to base your trends. Model 2 is actually the mean reversion model, and that's the model that we have been the most practiced with, the most experienced with. That's the model that we have seen to have the highest win rate. That remains the same. It did get a makeover in terms of the appearance, but largely it behaves similarly. You have zone 1, which is zone 1 for the bearish and a zone 1 for bullish. So if the price ever dips into the blue zone, you're going to expect to see the prices to move upward towards the white line, which we are going to call the kernel reversion mean. It's the mean for the mean reversion strategy. And similarly, if you see the price rise up into the orange, you kind of expect the price to make its way back down to the mean. Now, one thing we added is that we now added feature regime detection. It was a feature in the previous model too, but it was not as well displayed. And what this kind of shows you is that at the moment, it's blue and orange again, but I think the colors for that are subject to change. The background colors are indicating to you what the model thinks is going to happen for that equity. So if the background is blue, I think the model is predicting that, hey, things are looking great. You could comfortably long in this period. The moment it goes to the gray or the neutral black background color, that's when it indicates that the market is changing and change is happening. And when the model is orange, that's to indicate that, hey, we are in a bearish trend, a bearish regime. And that is what the second major update has been. And lastly, we have what we call the momentum reversal strategy, which is indicated by the triangles. The white triangle is a recommended entry into the equity, and then the purple triangle is a recommended exit. Now, one thing to keep in mind that these are recommendations, so you should always use your own analysis, but it is a great tool to enter the market and a great tool to gauge if the market might be exceeding what it should. Might be exceeding, or it might be reaching a high, which it might not reach. I think that's overall been the major update. 3 modules, 1 for trend prediction, 1 for mean reversion, and 1 for the more conservative users who want to scale in slowly and reap profits that way.
Yeah, and one other thing I want to add is we have a official name for this model.
Mm-hmm.
We are going to call it Anchor. Is that right?
Yeah, Anchor.
Yeah.
Yep.
So that's going to be the name moving forward. When we describe the model, we'll be using that name from here on out.
Mm-hmm.
So please don't get confused when you hear what that is, rather than us just saying, "Oh, we're talking about the model, and this is what our model is going to say."
Mm-hmm. Yeah. Is there anything else we want to bring up for today?
I don't think so. I think that's basically it for today's episode. It's quite short compared to the ones we've done so far.
Yeah, unfortunately, there was no real spice in the market. There has been spice in terms of media and politics, but we don't want to dive too much into that.
Yep.
So we'll keep this strictly about the economics and the market rather. And I think on that end, I think the other data that's happening is not as important. There is retail sales on Thursday. There's some housing data, building permits, and the Michigan sentiment survey. So I think those are events, but I think they don't hold a candle to inflation and CPI. So it's good to keep an eye on them for sure. But I think what we should definitely pay attention for next week is going to be the CPI. I think that's going to determine how the week plays out. So be ready. It might be a time to buy in. Last week we were searching for opportunity. This week we might get it.
Yep, that's right. Okay, that's it for today. We'll see you guys next time.
Thank you so much for watching. Please subscribe. Bye-bye.